Welcome, everybody, to the Ask an Accountant podcast, where we demystify accounting by simply asking your pressing questions from the industry's best and brightest. My name's Tony Wilson, your host, quirky friend, and total accounting nerd. Today, I'm joined by my friend, Ryan Yates. All right, let's get out the list. So he is the Managing Director of Cardinal Financial Consulting, the VP of Finance and Compliance at Veloce Capital, co-founder of the Fund School, bouncer at a local brewery, accomplished actor in the renowned Dad's Night event, and the list goes on and on. I genuinely don't know what this man doesn't do. Maybe you said spelling just before this?
Yeah, I mean, thanks for having me, Tony, but spelling is definitely not my strong suit.
Not so much. Maybe taxes could be another, but even taxes, like, who knows?
No, I'm not a tax fan.
Fair enough. But wait. I thought you were an accountant. I thought all accountants do tax, though.
I think that's one of the biggest myths. Not many people like to do taxes. That's what,
That's
CPA
true.
is for.
That's true. Amen to that. Well, Ryan, welcome to the show. I'm super glad to have you on today.
No, thank you for having me. This is great. I'm looking forward to it.
Yeah, this is good. So one thing, Ryan, I am especially excited about is that you and I both share a passion for teaching and developing the next generation. So for everybody watching, in a recent LinkedIn post, Ryan gave me quite a bit of inspiration when he posted a picture of his daughter who had started a business. And I know that he does a lot of coaching and teaching even his kids about entrepreneurship. And I love it. And I'm like, I want to be the kind of dad that does that. So I love the stuff you're doing with that. And, teaching is so ingrained in who Ryan is that we're actually collaborating on a project that he started called Financial Literacy is Now. He also is the co-founder of that Fund School. So lots of just teaching stuff just oozing out of everything he does. So Ryan, do you want to maybe tell us a little bit about what the Financial Literacy is Now is, what the Fund School is, and what inspired you to launch those things?
Sure. It was so many conversations that come across every day. I mean, from my parents to friends to, college graduates about, fairly simple financial literacy questions that no one ever addresses. It's slowly being picked up in the mainstream school systems. They're bringing it on. That's how my daughter ended up in TREPS, which is an entrepreneurship program. It's really her third business. Her and her friend did dog treats for 2 years. Went on to, of course, the lemonade stand, which everyone, kind of kicks off for the first time with. And they just made bracelets. And, this past week they had their first show. My wife is a little bit more of a pushover than I am. They made around, I think it was $75 each.
Not bad.
I mean, overall with costs and expenses, they probably broke even. But it's interesting, and we really need everyone to learn. 401ks people have, but they don't actually take part in because no one ever explains it to them.
Mm-hmm.
So I think that's where financial literacy now is going to kind of lead to, is we're going to help, get the information out there and start young, because that's how things get ingrained to kids. And we just want to make the world a better place.
Yeah, that's amazing. And you're talking about that, and even when you approached me about, hey, would you be interested in participating in this? I'm like, this is a no-brainer, because I remember hearing recently, I think I was probably listening to a podcast or something on it, but basically the premise was that so many people, they get into their first big boy, big girl jobs, and they've never been taught. They go through learning all about social studies and all these other areas in high school. Nobody ever told them about just basic budgeting, basic bookkeeping, any of that kind of stuff.
Even when you get your first paycheck,
Right.
think about all the taxes taken out of that. No one ever thinks about.
Right. Yeah. And so there is totally a lack of that knowledge. So I love what you're doing. I love your teacher's heart. This is a no-brainer to have you on the show, because you have a lot of knowledge to give us, but also a teacher's heart to deliver that with. So I'm excited to have you on. Do you want to maybe give us a little bit of a background on kind of where you've been? Did you go to school for accounting? Did you just stumble into it? Talk us through your experience.
So I did go to school for accounting. I was one of the lucky ones who picked it. My going into high school, my choices were teaching and accounting.
Mm.
I'm sure, I mean, New Jersey pays fairly well, but when I saw my math teacher starting salary of 24,000 back in 1999, I was like, oh, I don't think I can stomach that. So I went accounting. But I did stumble into this wonderful world of alternative investments. My first job interview in 2006 was, "Do you have a car and will you show up on time?" Didn't explain my position at all, and it was a fund administrator for alternative investments. So, and just to give you a brief background, I spent about 15 years in alternatives, maybe a little longer at this point. It's kind of hard to forget. Focusing on the alternative space, which is basically hedge funds, private equity, and real estate.
Hmm.
There's always little offshoots and things like that, but the world of alternatives has been good to me,
Hmm.
and that's why I am where I am.
That's super awesome. I mean, I mean, you have a lot of variety of experience, right? You didn't like stay in just one spot. You've been to a couple different companies, right?
Yeah, I've worked for Citi Hedge Fund Services, Morgan Stanley, State Street, in all different divisions.
Hmm.
I've even worked with crypto.
Whoa.
Yeah, it's exciting and fun. It's very volatile. I mean, as everyone can see at this point. But it's also very early in adoption for the government.
Hmm.
So it's a little shaky when you go into it. But I mean, it's the future. So it'll be interesting to see where everything goes.
Yeah. To what extent have you been involved in Dogecoin?
I made 50% on it once.
Whoa.
But it was when it was at like 6 cents and it went to 12 cents.
Oh man.
I'm an accountant, not a finance guy. I was happy with my $150. I didn't need to go to a million. I would like
That's
it, but I'm not going to go for it.
that's good. That is really good. Okay, so you threw the term out there, and I want to make sure that we demystify this term. You said alternatives and alternative investments. Fun fact for everybody watching: I actually did not even know what alternative investments was. I literally thought before we hopped on the call that we were going to be talking about like renewable energies or that kind of stuff because I think alternative, like alternative energy. I don't know. So you want to maybe demystify the concept. What is alternative investments?
I mean, I've been in for about, I think it's been 15 or 16 years. And, you hear the word alternative investments. And 16 years ago, it was just hedge funds, private equity, real estate. It was stock market because, how did you invest? You didn't have Robinhood. You didn't have all these other, apps to trade or anything like that. So equities are alternative investments. So I think the progression in the U.S. has been to demystifying it, but it's also shrouded in secrecy with the SEC and all those rules. So I mean, mainly we break it down to venture capital, private equity, real estate, and equities.
Hmm.
Those are like the four main sections that I've dealt with.
Hmm. And you've had experience in all of those areas, right?
Yep. And I've worked for some really, really big firms and some really, really small firms. We just, earlier today I was chatting with someone on LinkedIn and we were talking about hedge funds and, Melvin Capital going down and everything like that.
Hmm.
And it's really shocking that 80% of the funds don't make it past year three.
Oh wow, I didn't know that.
So you see all these big names out there. Appaloosa Management was in New Jersey before they went down to Florida, and I mean, you can name any one of them that are billions. There's so many down there that collapsed that don't get close to that point.
Wow.
So it's a very fickle industry.
Yeah, I imagine so. You had said something about SEC and kind of shrouded in mystery and that kind of stuff. One word or one phrase that I think would also be really helpful to have you speak to or like maybe define a little bit better is the term accredited investor. What is it and why does that term matter for the common person?
Well, because most common people are not accredited investors, so I think that's what kind of helps shroud everything in mystery.
Mm.
There's three ways you can invest in a fund basically. They have an income limit based on how much money you make in a year, whether you're single or married. I think it's 200,000 a year single, 300,000 married. Net assets, I believe, around 5 million. If you not including your house of residence, I believe, if I remember correctly. And then they do have a professional designation, but that kind of limits you. So,
Hmm.
I work for Veloce Capital, which is a real estate investment firm. Technically, since I'm the VP of Finance and Compliance, I can invest in that fund only. That's
Oh, got it.
the criteria. So there's a bunch of rules out there, and I think, just to go a little further, that's kind of where the fund school idea came up. I'm
Oh.
working with Jeff McDermott, and he and I were speaking about how to, help everyone out because it's not just for accredited investors. And we came up with the fund school, which helps teach people how to invest and how to create these funds.
Hmm. That's super cool. So you had said when it comes to the topic of accredited investor, you had said that there's certain qualifications in order to be considered a accredited investor. So if I'm not an accredited investor, let's say I'm just like a common person and I've now discovered I am not an accredited investor, what are the implications for that for me as a would-be investor?
So there's a bunch of options out there, and it really comes down to the different regulations by the SEC.
Hmm.
There's a Reg D um, investment type where you're allowed 35 non-accredited investors. There's other rules that you need to follow to be able to invest in that. But the two major ones that have come up recently are crowdfunding and Reg A.
Hmm.
They're both great options to get people to invest in things they normally wouldn't.
Yeah.
The two main differentiators are crowdfunding is for about $5 million. They don't really like to offer too much out. And then Regulation A, which came out, gives you more. It's basically you have a $20 to $75 million option
Hmm.
that it's expensive to do, but it gives you abilities to reach out to non-accredited investors and give them the opportunities that are up and coming.
Hmm.
So a lot of startups, real estate investment firms like Veloce Capital. See, I even have my hat right here.
Repping the brand. Let's go.
So, we have these opportunities out there for non-accredited investors to come in.
Hmm.
Why not be able to invest in a company up the street that you believe in?
Hmm.
One thing that I try to teach with everyone is know what you invest in. I can go into stories about stocks that I saw rise up from pennies on the dollar.
Hmm.
Actually, Monster Energy. I wrote something on that on LinkedIn that, I was an avid dirt bike rider. We used to race. We used to do all that fun stuff, and we watched it grow from this little company that backed a few people all the way up to a NASCAR top sponsorship. They named their trophy after Monster.
Yeah.
So that was like one of the things. And Reg A gives you that ability to do that, and that's what's great about it.
That's a really unique perspective, and I don't think it's necessarily a perspective that I hear talked a lot about. Right? Is on the one side, I mean, the reason why people invest, one of the main reasons people invest in a company or in a stock or whatever it is because they want a return on their money, right? Like they want to put it away and they want to get more money than if they just put it in a bank. But what you had just said is like another really strong reason and purpose for investing your money is like if especially if it's like a business that's in your local sphere or something that you believe in, it's almost fun. Well, it is fun to be a part of that growth and that story. And that's not something that I feel like is talked a lot about when we talk about investments.
It is and it isn't. I think it's just early on in the process. I'm sure you guys have heard about WeFunder and a
Mm.
few other ones. If I go back 2 years ago, I actually bought a micro share in a horse. And that was just something I dreamed to do. And then my horse won the Kentucky Derby. I'm one of the 60,000 investors in Authentic, the horse that won. I think it was 3 years ago at this point. But it gives you opportunities to invest and it gives you opportunities to expand.
Hmm.
I'm not a big fan of Robinhood and I'm not a big fan of all the crypto exchanges and stuff.
Hmm.
It's just scary what people can do. It's legalized gambling and
Hmm.
it it there's a lot of people out there who can't handle that. And you see people who go in with 5,000 and they leverage themselves. Even one of the guys committed suicide, what, 2 years ago?
Gosh.
He was playing with options and he had this huge call. And I mean, he obviously didn't know what he was doing, but you know, it needs to be in financial literacy. I think if
Mm,
people teach the stock market correctly, people either invest with someone who knows what they're doing or stay away from it.
yeah, that's really smart. And it's especially when you talk about this space. Sometimes if you're not well educated in what exactly it is that you're agreeing to, or the implications of what you're agreeing to, yeah, you could be in a really bad spot. You talk about anything having to do with options, derivatives, like do not mess around with that stuff because you could be in a really, really bad spot. So that's a good point. So I want to circle back to that topic of accredited investor real quick, just to make sure that I'm like we're all understanding like what this is. So I have heard as an if you're not an accredited investor, essentially the reason why the designation is so important is um, because you are actually restricted from, or the funds cannot reach out to you and ask for money to you to invest money into the fund. Is that right?
Yes and no. It
Okay.
depends on the structures. I mean, the SEC has given, I mean, strict guidelines where, I mean, the problem is it's almost like a driver's license. You don't need one to drive, but if you get pulled over, you better have one.
Mm. Hmm.
And they put the onus on the funds, not so much the people, which would be
Interesting.
like putting the onus on the car and not you driving the car.
Interesting.
Because if we're talking, I'm like, yeah, I have $500,000 to invest, send it over. Early on, I mean, you're giving disinformation, but they
Mm.
can send you something. But technically, they're not supposed to.
Mm-hmm.
Now they do have accreditation firms. They do have firms that do it for free. It's on the fund to prove that.
Yeah.
You get in huge trouble if they don't.
So it's
So
really it's on the fund to figure that out, not necessarily on the investor. Like if the investor goes and invests the money, like they're not going to get a slap on the hand for doing that, right?
right, and it's getting well. I mean, they would get in trouble for it, but nowhere near as much as the fund will.
Hmm.
I
Interesting.
think that's kind of where, I mean, we can go into a whole hour on the SEC and how I don't believe what they're doing is being on the side of the investor at all.
Mm-hmm.
I think they're just putting band-aids on bullet holes and just
Mm-hmm.
kind of going along and whatever the buzzword is, that's what they go after.
Mm-hmm. Yeah.
But it's everyone's livelihood. It's making sure that it's all compliance and finance, and that's why they brought me into Veloce Capital
Yeah.
because the, we deal in real estate. We have wonderful returns. We have a Reg A, so I can say that.
Right.
Um, but it's a good business to be in because it's needed,
Mm-hmm.
and we have to protect ourselves as much as our investors.
Mm-hmm. That's really good. That's really good. You know, I've heard a negative that I've heard is, and for everybody who doesn't know, we've mentioned SEC. We're talking about Securities and Exchange Commission. So go look it up if you don't know what it is. It's a very powerful governing board in the investment space. You know, it's obviously they play a lot in your space. In my line of work, where I'm oftentimes working with public companies, they govern and they have a pretty large say into making sure that public companies are being forthright with their financial reporting. So they are a pretty powerful governing body here in the United States. But what I've heard, negatively speaking, what I've heard is essentially the government is telling people protecting people from themselves. How do you feel about that perspective?
That's my exact line. You stole it. It's funny. We were talking about. I mean, we're on the younger side, and I mean, I was at least in high school when it came up. But Enron
Mm-hmm.
and Arthur Anderson.
Mm-hmm.
I mean, those are the two major pushes. It's got to be 20 something years ago at this point, maybe even longer. I don't even know. Time flies, but it's they've been involved a lot, and I'm not gonna lie and say companies are not doing wrong.
Mm-hmm.
They definitely are, and I've seen, they're allowed to switch accounting styles technically. I mean, public companies, and they're allowed to switch it once, and that'll be a big boost. And like you said, when they're public companies and they report, there's a stock amount attached to that,
Mm-hmm.
so they're everywhere.
Yeah.
and they can make your life miserable.
Yep, that's very true. And they certainly have the teeth to enforce it as well.
Right.
Um, so we've discussed, we've dived into the accredited investor topic, something that I think you and maybe somebody else, maybe it's Jeff. I think I probably saw an early post that Jeff posted. But you don't have to be an accredited investor to start a fund, right?
Correct.
So, so. The logic would then go, the common person, anybody could start a fund, right?
Within reason,
Within
yes.
reason.
I
Okay.
mean, there are special certifications you should have for trading futures and um, FX, so currencies, things like that.
Mm-hmm.
But in general, there's very light paperwork.
Hmm.
You might need to um, file as an advisor in
Hmm.
certain places. They have different forms you have to fill out. But I mean, as long as you have an investment thesis and you can raise money, you can invest. I
Interesting.
mean, if you really think about it, starting a company and starting an investment firm are the exact same thing.
Huh.
And they're both businesses and they both make money for their investors.
So
So
so like with that in mind, like what makes somebody, let's say a common person does want to start a fund and they go and let's say they want to raise money because they want their fund to be all about real estate investing or something like that. Talk to me about like what are the kind of the things that are going to make that person successful as a fund manager.
hiring Cardinal Financial Consulting. No.
There we go. Name drop.
So, um, it's not easy to start one,
Hmm.
but working with Jeff in the fund school, we've got the processes down where we're helping people. And right now we're focusing on real estate and venture capital. So and this is kind of where the learning comes in. We can take you from, a group of five and give you all positions and teach you how to launch your funds and
Hmm.
teach you the process. The process is simple as, getting a legal entity set up, getting your bank accounts in line, making sure you follow all the regulations.
Hmm.
What they say, raising money is easier the more there is.
Hmm.
So we say it's easier to raise 500,000 than it is to raise 10,000. And Jeff had those connections, and he's able to make introductions and help out and show us how to kind of grow a fund out of nothing.
Hmm.
It's so many people reach out, and I've talked to emerging managers as Cardinal, and raising money is difficult, but
Hmm.
there are tons of ways to raise money.
Yeah.
You use broker dealers, you can use your own network. And then once you get the money in, it's just allocating it correctly and making sure you have the operations in line.
Hmm.
And that's the key. The key is you need to make sure that you're in compliance and your operations are smooth.
Yeah.
Because, I mean, you probably see, almost monthly, you see someone get in trouble by the SEC because of, expenses or doing something
Hmm.
nefarious.
Hmm.
So, it's 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 a little scary and it's not easy,
Hmm.
but it's doable. And if you have the passion or the interest in investing and you've always wanted to learn, that's what the fund school is there for.
Hmm.
And, make a small investment. The investment goes right into the fund. It's not even like we're taking it. And
Hmm.
you can invest your money and learn about real estate or learn about venture capital.
Hmm.
And you you grow from there. And
That's super
that's
cool.
yeah.
Well, and it sounds. I mean, this is the thing that kind of blows my mind is because, like, at least for me, as like a non-educated in this space person, I just assume, oh, the people who run funds are like Ivy League educated, like finance professionals. Like, oh, this is a totally unattainable thing. But everything I'm hearing you say, it's just like literally anybody could do it with proper training, which is why you got the fund school. And there's things to like keep in mind, but it's not as far away of a concept as people might think.
So I find a lot of doctors and multiple doctors, not just medical doctors,
Hmm.
and scientific researchers and um, data engineers, I guess is the easiest way to put it. Those are the people that are actually looking to start funds. If you look at the crypto side, you see people mining,
Hmm.
which is basically gathering power, gathering up this the computer processors and mining coins, and you can make a killing.
Wow.
A special a niche that you can go to, like maybe you're in geology and you know a lot about gold, and that's right, geology, yeah. You're in gold or silver and you know where the mines are. That's something you can invest in. So it's really just using other people's money to make money. So I mean, you have your equip, which is a great. I mean, you should talk about that more because the way you teach and grow.
Hmm.
But if you wanted to start that with capital, you can reach out to people and you
Mhm.
can bring it in, and it's all the same thing. It's just using other people's money
Yeah.
rather than using your own.
Right. Right. That's essentially what it is to be a fund manager. You're aggregating, you're bringing people's money in, and then bringing it and putting it in the good, investable ventures or assets or whatever those things are.
Yeah.
So that's super interesting. Give me one second. Still recovering from COVID. Anyway, that's super helpful. So that was my biggest takeaway. Is I'm like, this is really fascinating. It is so much more of an approachable topic that I think people don't realize. Starting funds. So I'm curious on the topic of starting funds, and let's say somebody does go and launch their own. From your experience, from what you've seen, how many people that are starting funds or have already started funds work with a dedicated accountant versus just doing their own books? And why would they want to hire an accountant?
So, I mean, as we all know, across the whole industry, accounting is extremely important because everything's a small business.
Mm-hmm.
There's no, if you're launching an investment fund, yeah, you're investing other people's money, but it's your business as well. Um, it's, I think a lot of people think it's easy. To launch a fund comes somewhere between $50,000 to $150,000, depending on how big you want it and where you want it. Even portfolio managers that go out on their own and hire, say, fund administrators instead of having internal books and records run risk. And I think that's something that investment people are so smart at, but still a little dumb at, is we worry about investment risk.
Mm-hmm.
My job is to worry about all the rest of the risk. And
Mm.
that's the way I look at it. And I mean, I have plenty of connections on LinkedIn of old portfolio managers that me as a fund administrator would reach out and be like, hey, I know I'm not doing this, but you should probably do something like this. Or they'd wait too long to hire one. Um, it's an unnecessary risk, and it's an expense, of course, and it could be very expensive if
Yeah.
you full time. But to have an advisor or a consulting firm that can step in and help out on a part time basis is a huge step forward.
Hmm.
Um, just for a small story, I was working with someone and they gave me their PPM, and the fund was up and running for 4 months. And you expect your lawyers to read everything. Well, the lawyers just pushed through a template, and they were charging management fee wrong.
Oh no.
So you really have to be careful. And it's finding someone you could trust to kind of give it a second set of eyes, or
Mm.
just, you know, pay a little more attention where you don't need to.
Yeah.
You have to invest. Investing is from the opening bell to the closing bell. If you're in equities, real estate's a little more spread out. You might have a little bit of downtime. Crypto is 24/7.
Hmm.
Think about if you're trading in crypto funds, you don't have that downtime.
Mm-hmm.
So you really have to kind of measure out, where you need the support.
Yeah. That's
And
that's really good. Yeah. And,
that's
and yeah, and I would say, like, honestly, Ryan, even your observations, I feel like are pretty common. Like, they're transferable to other industries, not just funds. Obviously, in this space, you don't want to be making a mess of things. I think back to the interview we had with Steve, who specializes in law firm accounting, and it's like, why would you skimp? Why would you skimp in a place in a field that is so highly regulated? But like you've mentioned, you pick these books up for the first time after they've been running for a couple months or maybe a year or multiple years. only to find out like, ooh, this has not been handled super well, and it costs people more money in the long run.
Right.
So
Yeah, it's difficult, and especially with all the moving parts, because to launch lean, you think you can start with one person, but you can a couple analysts, maybe an HR person for the front desk, and then you outsource everything else, which is great. But depending on who you outsource to, you don't know what you're getting back. I mean, if you have a track record with someone for 10 to 15 years, you have a good shot. But if you don't do that, you need almost a chief of staff, like a
mm-hmm.
CFO or a consultant that could come in and kind of oversee everything so you could focus on what you want.
Mm-hmm.
And one wrong trade can cost you $100,000, and you'd be paying 20,000 for the advisor. So if you really want to take a look at that loss, where you get it from, it can be costly.
Mm-hmm. So needless to say, hire an accountant. That's what I'm hearing. That's what I'm hearing.
Yes. It doesn't
Especially,
have to be full time. You can do
right.
consulting. Perfect.
That's true. Yeah, work on a fractional basis, especially if you're starting off small. There's no need to, if you don't have all the work to hire an individual person, you could still hire at a fraction of the price, and you're still getting massive, massive value, especially if you're working with this guy over here. But besides that, Ryan, thank you so much. I know we didn't get to all of our questions today. As I told you, we probably wouldn't, but that's okay. We always try to keep these to about 30 minutes. But Ryan, I'd like you to put your hat on, your words of wisdom hat. Oh yeah, I mean that one.
You want to come up so everyone can see it?
Perfect. I'd love for you to envision, if you will, for a moment, a group of emerging managers. These are people who are in the process of, or maybe already have recently launched their funds, emerging managers. What words of wisdom would you don on these fine individuals?
In general, it would just be, don't go it alone. There's no need to. Even, I'm always available. I know there's other people available. If you just want to even have the conversation, it's something you need to have. They say there's no such thing as a stupid question. That's true. You don't know everything. Now, I've met a lot of portfolio managers who have an ego problem, and I think anybody can kind of say that. But reach out to me. It's quiet. It's confidential. No one's going to hear from it. Might tell the story with fake names, but that'll be from me and my accounting buddies later on. But yeah, just don't go to and get the support.
Don't go it alone. I love that advice, and I feel like that actually is an echoed sentiment that we've heard on previous shows. So you heard it here from Ryan. If you're an emerging manager, don't go it alone. There's no need to be a lone wolf in this. You've got people who have your back, who want to have your back. So just reach out, and then you'll be in a good spot. So Ryan, if people who are listening to the show, they really like what you're talking about, they want to get to know you, they want to follow you, where are you at? Facebook, TikTok, Instagram, LinkedIn, where are you at?
Listen, I'm part YouTube famous, especially being on this podcast.
Mm-hmm.
I was what was I? A Scottish dancer earlier this year on YouTube.
That's right, accomplished dancer.
I'm an accomplished dancer. I've been on TikTok with my daughter. Unfortunately, I don't have one, but I'm on Facebook and LinkedIn. We have Cardinal Financial Consulting, Ryan Yates. And I try to post at least positive things, except for today. It's a whole nother conversation. But I'm everywhere.
That's good. So Facebook, LinkedIn, those are two primary social media sources. I will just say Ryan posts fire on LinkedIn. I follow him. I interact with him on a regular basis. So please go and follow him if you have not already. He's amazing. Love the dude. I mean, that's why I have him on the show. So,
of course.
But Ryan, again, I just want to say thank you so much for letting me interrogate you and extract some knowledge from you. This has been lovely.
Thank you, Tony. It was great. My pleasure.
Absolutely. And I hope everybody who's listening, you have all found value in our episode today. If you have a pressing accounting question that you would like future guests to answer, you can email them to me at tony@acquip.com. That's ACCQUIP.com. Also, if you are an accounting professional or you know one who would be interested in coming on the show, please reach out to me as well. Thank you, everybody, so much for tuning in. And as always, keep calm and keep your clothes on.